structured, why are there, so that at least these are important, let's say, fundamentals that you can bring whenever you read and apply these rules. Because if you miss this, maybe it will be difficult to understand why a certain rule is there. So this is really where my speech is going to be focused. So I'm sure that all of you are aware and remember that for many years we were talking about BEPS, right? Base erosion and profit shifting project of the OECD and G20. So why is it important this? Because we need to understand where, let's say, the pillar 2 is stepping into the scene. Because otherwise, it seems, I mean, did you ever think that pillar 2 seems something like just thrown by the OECD somewhere, and we are not able to reconnect where to position this pillar 2 thing, right? Am I right or wrong? I mean, do you have any comments? I mean, don't you think that pillar 2 is somehow thrown somewhere, you know? But actually, it's not that thrown somewhere, because we're going to see in a minute, because let me step back to the BEPS, base erosion and profit shifting project. So, what was happening around the world before the BEPS? Before the BEPS, there were a lot of structuring that were actually bringing revenues to countries where there were no economic substance whatsoever. There were no functions, no risks allocated, right? So that's what the OECD stepped in and said, hey, we have to control this, because otherwise we're going to shift revenues from countries where taxation is high to countries where taxation is zero or low, but in these countries there is no substance, there are no people, they are just somehow empty boxes, so we shouldn't allow this. So that's why base erosion and profit shifting project has stepped in and to put some rules, some blockers to impose multinationals to basically continue taking benefit of special tax regimes, etc., but upon condition that economic substance was built in those countries. And what does it mean? Mainly moving or hiring people in specific, let's say, key roles to take those responsibilities and having those functions run locally. So BEPS has not eliminated tax planning whatsoever. BEPS has just added, let's say, more complications and more economic substance requirement to continue having those benefits. Okay? So, but what happened is that there was basically a strong migration of people managing to those countries where tax advantages were there. So OECD came back and said, oh, we have a problem here because BEPS was fine. So they started, let's say, bringing people to the places where revenues are allocated, so it's fine. But we don't want this distortion, because this is creating, in any case, a distortion because it's not stopping, it's not tackling tax planning. Right? So the BEPS evolution is now, and how it would be named in the context of Pillar 2, is we move from base erosion and profit shifting, that is exactly what I just summarized as finding economic substance to justify the shifting of profits, into base expansion and profit sharing. So BEPS is the same, let's say, it's the same wording, but now the meaning under Pillar 2 has changed because it became base expansion and profit sharing. And I will focus particularly on the profit sharing, that is very important about Pillar 2, because this is one of the, let's say, really breaking points of Pillar 2 that creates a lot of theoretical issues around sovereignty of states and possibilities of claiming taxing rights over something that is actually happening in another country. So what happened, these are actually data from the OECD. What has happened over the years in the world? There was a race to the bottom because all countries were actually reducing corporate income tax nominal rates. You know, you see from 1990 to 2018 what happened, you know, from 46 average down to 22, 27. So, and this was with the idea of attracting new investors. You know? So, having a more friendly, let's say, country to attract foreign investors, right? So, but the OECD didn't like that, you know. Don't ask me whether it's right or wrong. I'm in favor of tax competition. Absolutely in favor of tax competition. If a country can afford it, I like that a country can apply to it. You know, why not? But the OECD was not happy about it and said, we need to intervene here. Also because, to be honest with you, did you see a material effect of the application of BEPS through the treaties? We know, of course, permanent establishment, definition of permanent establishment, modification and restrictions have been implemented, you know, through the minimum standards. Then the, let's say, other, let's say, restrictions in the treaties, but at the end of the day, even the MLI, that should have modified treaties in 1 second, has not been that effective. That's why Germany, for example, just for you to know, decided most of the time to not apply the MLI and renegotiate treaties directly with countries where economic relationships were very strong. In 3 years' time, they modified the most important treaties for them, and now, instead of having the MLI 200 pages in total with the commentary to protect tax authorities in case of tax litigation, they have 3,000 pages of the OECD model commentary 2017 protecting them in case of tax litigation. Okay? So I'm more in favor, of course, of the change into treaties directly for the same reasons. So now, regardless of my humble position in this respect and the position of many other, let's say, professionals and scholars, the OECD decided to step in with the Pillar 2 project. What is the Pillar 2 project? It is a mega anti-tax competition rule. This is what it is. They don't want, OECD doesn't want tax competition. They want to stop it. They named it Pillar 2, but it could have renamed as mega anti-tax competition. So, this is where we are now. Alright, so, of course, there were many papers released by the OECD, as you know, starting from the model rules, the commentary to the model rules, the examples to the model rules, then administrative guidance, safe harbor, information return, draft, and tax certainty for the application of all these rules. If you have the chance to look at these papers, most of the time you have the feeling that they are in draft, you know, like they are in advanced draft, but they are not finalized yet, you know, like. And it's true, by the way, because OECD is running, in this respect, it has certain like commitment. So I would say that some of them have been really released in the rush, you know. And sometimes there are even contradictions between chapters because probably they correct one chapter, but they didn't go back to the other to correct the point to make it consistent. So, but it's okay. It is good that this came out, but you know. Sometimes when you don't find, let's say, clarity, is also because still in, you know, an advanced draft, just for you to know. And recently, these other documents have been added to the pool of documents composing the Pillar 2 project. Now, let's move now to some examples to, again, focus on the rationale. This is really the important to understand. So, okay, first of all, the key rules of Pillar 2 are summarized here. A few months ago, there was, let's let's say, there were doubts around what is the correct sequence and rule order of this rule, part of Pillar 2, but then this has been fixed, and this is the final setup, okay? So, first we have the subject to tax rule, or 5 domestic minimum to tax tax, the income inclusion rule, and the under-tax profit rule. So, let me start with the first one. Subject to tax rule is something honestly separate from 2, 3, and 4 here in the slide, because this is the treaty-based rule. These three are instead tax policy rules, so implemented, to be implemented inside, let's say, the tax systems of each country. So, subject to tax rule is basically, we're going to see in a second, I don't want to anticipate, but let's say treaty-based and this other three are tax policy-based. And this is the sequence. We're going to see in a minute why it's important, this sequence. So this is the first one, second, third, and fourth. Now, let's move to an example just to make it more vivid, So, subject to tax rule. I want to explain the first one on the left hand, which is really the first one in the sequence. There is basically, as we said, a treaty-based rule. Okay, so what is the purpose, first of all, of this treaty-based rule? This treaty-based rule is to somehow allow developing countries to retain some taxing rights whenever the developed country is not meeting certain thresholds. Okay? So the example here, which is a very easy example, is done with the royalty. The royalty is article of the OECD model. You should know that the royalty article of the OECD model is structured in a way that basically no taxing rights are allocated to the source country where the income arises. So the country that is taking the advantage of being able to utilize, for example, an intellectual property, a design, etc., that by definition normally is a developing country. Because the developed country owns the IP that is given to this country, to this entity in this country, in exchange for the payment of a royalty. That's why the royalty arises in state S. State S is, let's say, the deemed developing country. So what's happening here? Normally, based on the OECD model, there is no taxing rights allocated to the source country. OECD model. I know the majority of the treaties have been modified based on the UN model to retain also some taxing rights at the level of the source country, especially when this country is developing. But just following the OECD model, there is zero here. Okay, it's just a presumption. Even though I know that the trend, the majority of treaties includes this, let's say, retention. So, whenever a royalty is paid, for example, to the other country, the test that state S is doing is basically, what is the nominal rate in state R? If the nominal rate in state R is actually below 9%, this has been fixed as such, then this state has the right to exceptionally override the treaty, let's say, if shaped as per royalty article of the OECD model, and apply 9%. Even though normally, as I said, based on the OECD structure, the royalty article does not allow the source country to tax anything, right? So, is this 9%, let's say, bringing to you anything around this part of the world? UAE, right? Exactly. This is why UAE is about to introduce 9% corporate income tax. Because in this position of state R, they didn't want to have state S applying any law. Got it? Okay, this is exactly why UAE decided, because, many people ask me, why 9%? This is the reason. To protect UAE from the subject to tax rule. Okay? Any questions? Please feel free. I mean, it's an open conversation. We have communicated time to discuss. Please. Can we have a mic over there? Thank you. Please.
I just want to ask you, like, if quick implies like 8% tax in this one.
Kuwait, you're assuming
For example,
Kuwait is here, state as source state?
Yes.
Or resident state?
No, in the tax rate. Like the way have implemented.
So up or down? Kuwait, in your example?
No, up.
Up, okay.
Yeah. So if they imply it and they will take the tax from 8% here and then 1% in the way.
In reality, if the taxation, the threshold is not met, they will take 9% here.
Okay.
They will not take. Your question normally is raised at the level of state S, if state S and the domestic tax law has already a withholding tax. Let's assume 5%, okay?
Yes.
So in that case, state S is allowed to apply the difference between 5 and 9, 4, as exit withholding tax, as an exception to the treaty. Because the treaty, we assume, has no withholding tax allocated to the country of source. So here, state S. Okay?
Thank you.
So, now, the general principle, this is very important, especially for Kuwait, is this one, top-up tax. Okay? So, you heard me a few minutes ago when I said, I'm totally in favor of tax competition, even though these measures are against tax competition. Okay? So, I'm in favor of Kuwait having good regimes, let's say, attractive regimes in terms of taxes. But unfortunately, what's happening around would allow another country on top of Kuwait to claim taxing rights over any profit arising in Kuwait that has not been taxed at least 15% effective tax rate. This is the issue. The introduction of the concept of top-up tax, okay, is the critical point. So I might decide, as I told you, I'm in favor of tax competition, so it's fine. If you can sustain to have 0%, why not? But there will be someone else on top of you, another country saying, okay, if you apply 0, I'm going to tax all your profits, your extra profit, and by the way, there is no extra profit because it's 0, for example, and I will get this in my country, and I will get this tax in my country. So if you have Germany on top of Kuwait, and Kuwait is doing nothing, and Germany applies, and we'll see in 1 second, income inclusion rule that basically is the, let's say, summa, let's say, rule of pillar 2, so that you can bring to you up, top up any extra profit coming from another country that didn't tax at the same level. Then, even though you don't do anything, somebody else will do and tax. So now let's move to, okay, the effective tax rate is very simple in terms of formula, very complicated. What's behind the adjustment of this numerator and denominator, adjusted over taxes, adjusted over income. Very easy, but as you all know, it's very complicated. Now, another example to explain to you QDMTTs, qualified domestic minimum top-up tax. So, in this example, you see there is a country on top that has introduced income inclusion rule so that they can tax whatever another country was not able to tax. Okay? IRR. And there are other states below 100 companies that are taxed above 15%, so they are out of scope. But this one, this company, state 3, is below 15%. Okay? But in this case, this country has implemented QDMP. So let me try to explain in an easy way what's happening here. So, what is the good normal way that we're going to see in the tax policy suggestion in a while to block somehow, to tackle that another country will claim taxing rights over your country? That you introduce the qualified domestic minimum top-up tax. Does it mean that, in a nutshell, if there is an entity, let's say, my example, Germany on top, and there is Kuwait. Okay? So if Germany is there and implements Pillar 2 income inclusion rule, is ready to get any extra profit coming up from all over the world. Okay? So these other countries all over the world can somehow tackle or minimize this impact as soon as they have QDMTT, so rules that are blocking the application of IIR. So they will say, okay, you know what? Yes, there is an extra profit here, but I'm going to tax. I have the privilege of taxing myself first. And of course, if IIR in Germany are applied, then this will result in a credit out of the calculation rate. Unless we are in a certain situation where certain, let's say, exemptions are there to, yes. I'm 23 minutes out of the 30-minute speech, so 7 minutes left. Thank you. So, income inclusion rule is exactly what we saw now. In situation where nothing is there, nothing is here, okay, there is this crazy rule, this is really a crazy rule, that implies that a third state can step in and tax the whole thing. You know, so nothing top, nothing down, just nothing. This is really, let's say, moving out of the list. So, just to summarize and wrap in the last 2 minutes, just to say a few things around how Pillar 2 can impact your country. So, wait. Let's see the tax policy suggestion, and I'm going to finish. So, of course, I'm available all day around, so please approach me if you need any, let's say, more in-depth clarification. So, as I said, retention of taxing rights became the priority. So, states are now focused more on introduction of QDMTTs, qualified domestic minimum top-up taxes. That means I want to block, first of all, before even considering income inclusion rule and all the rest, I want to block the possibility by any other country to tax my extra profit. Remember my example of Germany, Kuwait. Germany on top, Kuwait as a source state. So, first, retention of taxing rights. This is the first message. Second message, introduce or increase corporate income tax statutory rates to limit tackle extraterritorial taxation, because there are countries with no taxation, like UAE was, they will start introducing corporate income tax just to, let's say, minimize the impact, but there could be countries even moving from 0 to 25%, for example, you know, just going forward to say, more or less the effective tax rate should be always above 15%, so no problem at all. So you can do it with QDMTTs if you are below that 15%. If you are, or you can play around the corporate income tax rate to make sure that, you know, is in general satisfying the minimum requirement of 15%. Introduction in domestic tax law of QDMTTs, I just explained now, to block any extraterritorial taxation, and then, since we just discussed about incentives, you know, just before me, it's very important all over the world that any tax incentives to be aligned with the OECD and to be aligned with the Pillar 2 project to be cash refundable. Okay? I'm coming from Egypt. In Egypt, is a very interesting, let's say, 50% deduction on investment costs, tax benefits. This rule has not been modified. This rule will decrease the effective tax rate. So there are action all over the world to make sure that these incentives are modified or the new ones are introduced to be on a cash basis. So if the taxpayer wants, can cash the benefits. This condition allows that these benefits are not reduced in the effective tax rate, but actually are added to the effective tax rate. Very last point, as you know, the minimum threshold to be in the net of Pillar 2 is total revenues, consolidated revenue of at least 750 million euros, which is equivalent to around 244 million Kuwait dinars, just for you to know. At least in 2 of the 4 preceding years from the date of application. Thank you very much indeed for your time. For any questions, I'm here.
Thank you, Giuseppe. Much appreciated. Up next, we have a session on corporate tax in UAE, led by our business tax partner, Joshi Aminu. So,
good morning, everyone. Hopefully everyone can hear me. First of all, thank you for the hospitality and ladies and gentlemen to express. My name is Abhi Joshi. I'm UAE Business Tax Partner, and I'm pleased to be here with all of you today. And once again, I just wanted to say thank you for taking your valuable time out for us today. So I'll try to make it brief. Anyways, I know right after my session we have the break. Okay. As you know, in the reason UAE corporate tax introduction was very hot and heavy news, and the reason basically back in October 2022, law number 47 of 2022 was published basically, and it was published in the official gazette in the October 10, 2022, and basically the law will be effective from Jan 1st, 2024 for the calendar year companies. But for fiscal year companies, starting from June 1st, usually it starts from June 1st, 2023. For example, Deloitte, we are a fiscal year company, so technically Deloitte UAE is already effective from June 1st, 2023. Now, the way we have it here is basically the tax return filing due date is 9 months after year end. So basically, from Jan to December year-end companies, the first filing due date will be September 2025. Just to give you the brief overview of the timeline and when is the tax return due. Over the past couple of months, I've been very busy attending meetings, seminars, because a lot of ministerial decisions, cabinet decisions, FAQs have been out, as we are already in October, and the law will be starting in 3 months' time. So these are just give you the overview of this consultation paper, the tax procedure guidance, and all those regulations are coming out day in, day out. So UAE corporate tax law, right? So basically, who does it apply to, and who does it implicate? So basically, all the UAE legal entities doing business in the UAE, the tax law is applicable to. And not only the legal entity, but also the foreign companies doing business in the UAE. Let's say the Kuwaiti headquarter company has a presence in UAE, and so of course it depends on what sort of whether it's a branch format or what have you. They are implicated for their share of the permanent establishment. Now, even the natural person, if the individual is doing some business activity in the UAE, depending on the business activity, even they will be subject to the UAE corporate tax, right? But the interesting thing is, if a UAE company has, let's say, a Kuwaiti branch or office here, but that Kuwaiti office here is effectively managed and controlled from the UAE, the thing is, even this Kuwaiti non-resident company here could be subject to the UAE corporate income tax. So you can imagine the plethora of the overarching rules the UAE corporate tax law is trying to impose in terms of the introduction of the UAE corporate tax. So the rule of thumb, so right now we have two tax rates in the UAE. There's a 0% tax rate for the company having a taxable income of 370,000 dirham, which is like around $100,000. And for any income above $100,000, the tax rate is 9%. So that's for the mainland companies, the onshore companies. And for the free zone company, the qualifying free zone company, as long as you meet all the tests, basically there is no tax. It is subject to 0% tax rate. All right, now I'm going to describe what the qualifying free zone in my next slide, so as we go through these things. But this is the key, the 0% and the 9%. These are the two rates we have to keep in mind. So now, these are basically all the rules. Now, the good thing about is the UAE corporate tax law is very simple, straightforward, at least for now. Of course, the devil will be in the details, but the number one source of getting your tax return started is your IFRS book income, right? So you start with your accounting net profit. There are several provisions of the rules, such as tax grouping. If you have, let's say, 5 or 6 UAE companies that are owned 95% or higher by the parent company, it allows you to do the grouping. Of course, the transfer pricing, which I believe there will be a separate session later today. Transfer pricing is also a very important development. All the intercompany transactions needs to be done in a very arm's length manner. So that's very important. There's some rules on the tax losses, the carry forward, the depreciation and amortization. Right now, we just start with the IFRS book depreciation. Whatever we have the IFRS book depreciation, we use it for the tax. Unless some other measures come into the play. And these, all these rules here, obviously, maybe we can discuss more in details during the Q&A session, but I just wanted to give you the overview of what are the key provisions of the law that will be relevant for, let's say, Kuwaiti companies having presence in the UAE that will be subject to this corporate income tax. Now, the free zone is also one of the very important developments that came. As you know, in UAE, there are several free zones from Jebel Ali, DIFC, AEGM, there's a financial free zone, there's a manufacturing free zone. And just a few months ago, it was not very clear how the free zone rules would come into the play. But the UAE Minister of Finance and the Federal Tax Authority came out with various cabinet and ministerial decisions over this timeline journey, which has made a majority of the free zone rules clear and easy to understand at this point. So it's a free zone, right? So let's say if it's a qualifying free zone entity, it needs to meet 2 tests or 2 requirements you need for the free zone entity to be subject to 0% corporate tax. The first is the free zone company needs to have substance, needs to have an office, employee, all the operation, all those things. It needs to get certain sort of qualifying income. It needs to follow the arm's length principle, the transfer pricing. And basically what it needs to do is that, now you might say, what do you mean by qualifying income, right? So there are certain rules that you have to follow by a free zone company for its income to be subject to a 0% corporate tax. Now, these are the quick example of the qualifying activity. Just to give you an example, Jebel Ali free zone, let's say I have a factory in Jebel Ali, I do the manufacturing, distribution, and what have you, and let's say if I sell that goods to another free zone company, if I sell that goods to, let's say, a Kuwaiti company, a foreign company, or if I sell that goods to any other mainland company, any other UAE mainland company, then all the income I get basically will be considered as a one-time income or a good income and not subject to 0% tax, right? So this is basically a brief overview of what the qualifying activities entail. So sort of similarly, let's say if a free zone company also holds shares or securities, that is also an example of a qualifying free zone. Now, but there are certain activities that are excluded activities is not really a good income. So same thing, let's say if I am a qualifying free zone company, and let's say if I manufacture a garment, but if I manufacture the garment and sell it to a natural person, let's say to my friend Ihab, as a person, even though me manufacturing the garment is a qualifying activity, but the fact that I'm selling it to a natural person, it becomes a disqualified activity, right? So I'm just giving you the example of the nuances and the ambiguities we have to keep in mind. Just because you are in a free zone doesn't make you exempt automatically. You have to meet certain rules and regulations. So I would be remiss if I didn't talk about the free zone without talking about this example. So basically, what it says that usually a free zone can have all the good income, but if it has any bad income, let's say me selling garment to EHUB, that is excluded. As long as my bad income is up to 5% of the total revenue, or the 5 million dirham, whichever is lesser, then it is fine. So what does that mean in the numerical example, right? So let's see here, let's go through this analysis here. Example one. Let's say if I have a free zone company, a manufacturing company, my revenue is 150 million dirham, and my non-qualifying revenue is 5 million dirham. I have a total revenue of 120 million dirham. The 5% of the total revenue is 6 million, right? So the 5 million is basically, the 5% of the total revenue is 6 million, but basically I'm getting the bad income only of 5 million dirham. So since my minimum de minimis bad income is up to the limit, I don't meet that threshold, the entire 120 million of revenue is a good income. I don't have to pay any tax. That's a good case scenario. But in the worst case scenario, example 2, I have a revenue of 75 million. The bad income that I get is basically 5 million, let's say a total of 80 million. The 5% of the total we have is a 4 million. But since my 5 million exceeds the 4 million, because it exceeds a certain amount, not only the 4 million is a bad income, it will take the entire 80 million dirham. So if you ask me what is the most important regulation of a free zone rule, I would say this one. So a small piece of bad income can take the entire $80 million of good income. And as if it's not bad enough, what the law also says is that not only you will be taxed for that year, but you will be banned for the next 4 years. So next year, even if I have all the good income, it doesn't matter. You will be taxed entirely for the next 4 years. So I'm talking to a lot of free zone clients, and they're very worried about this regulation and seeing what's the best way out to properly manage the situation. So just giving an example of the potential issues we have to keep in mind if, let's say, some of our clients here in Kuwait are planning to set up shops in the free zone in the UAE, and how this will be the consequences. Now, point, right? Place of effective management and control. Now, this will be important for us because let's say if a UAE company has an operation in Kuwait, but let's say it's effectively managed from the UAE. Let's say all the strategic decisions are taking place in the UAE, the board sits here and all those things. So technically speaking, because of this point, place of effective management rule, even though technically UAE has no jurisdiction taxing the Kuwaiti company, because here it's a foreign company, Kuwait, it's subject to the Kuwaiti tax rules. So even this foreign company here in Kuwait could be implicated and be subject to the tax in the UAE, right? So this is what the point rule is. So as we are evaluating clients, and our few clients in the UAE having operation in the Kuwait as well, so we are trying to see what are the litmus tests to avoid those the Kuwaiti companies doing business in Kuwait not be subject to tax in the UAE, such as let's say all the strategic decisions, the board meetings, the investment decisions, everything should be taken place in Kuwait rather than taking place in the UAE, things like that, right? But let's say if the decisions are taken in the UAE, then the risk is that the Kuwaiti company will be subject to tax in the UAE. So this is what I just wanted to summarize what the OM attribution rule is. And last but not the least, the corporate tax registration. So certainly the law is effective from Jan 2024, and the registration has already started for some of the companies. the private companies and the private joint listed companies. But certainly you have until September 2025 to register. But again, we're advising the clients not to wait till the last minute, do all those things. These are all the documents required, which is the passport, the ID of the signature authority, proof of authorization for the signatory, and all those things. And these are all the things, right? So, but these are all the administrative side, and we're getting a lot of queries from various foreign companies outside the UAE because they are worried that even they could be subject to the UAE corporate tax law. So in summary, I know I have screened through the UAE corporate tax law in a very a quick summarize, but what I want to say is that, of course, the UAE is part of the OECD's Inclusive Framework Member Country. OECD stands for Organization for Economic Cooperation and Development. And, so as the UAE, it has to be full minimum tax action requirement. Action 5 is for the preventing harmful tax practice. Action 6, substance. Action 13, country by country reporting. And Action 14, right? So as UAE, as my colleague just was mentioning, since UAE has also signed a global treaty to introduce Pillar 2 in the near future, it's one thing for UAE to sign a treaty globally, but not do anything back at home, right? So this is one of the reasons why UAE came up with the introduction of the corporate tax. Of course, as the law looks simple, but the devil is in the details. We're still going through those documents, still talking with the Ministry of Finance. And yeah, so this is how the law of the landscape is here. So if some of our clients in Kuwait have any operations in the UAE, we'll be happy to talk separately. And it's been a really nice meeting you. And now I'm not going to keep you away from the coffee break. So thank you so much. Bye-bye. We have 15 minutes.